Hi guys, good evening to all of you. Good evening. I hope you can hear me well. Uh, so welcome. I'm waiting till a few others join. Thank you for joining on time. So today we are going to look at task 3C. Today we are going to look at task 3C. Now, before I start, I am actually not in my usual place today. I'm not at home. I am actually up in the hills, all the way in on the top of Hantana, right? And I just finished a 2-hour hike, and I just came back, quickly did a wash, and got ready for class, right? So yeah, it was about a 2-hour hike, 2.5-hour hike. So feeling good, but it got by a lot of glitches. So I hope you can hear me clearly. Kindly mute all your mics. I hope you can hear me clearly. Please mute all your mics because I am in the hills, so there might be sometimes a disturbance or a little bit of breaking up of the signals. If so, please send me either a message on the chat, and then I will start from where I stop, or I'll switch to another Wi-Fi or my mobile data or a hotspot or whatever it is. Okay, so let's do today's session is very important. Today's session is a very important session, so please pay attention. Go and grab a cup of coffee. Your attention is very important today. So please, go to a place in your house where you can concentrate. Please be professional. Go to a place in your house where you can concentrate, where there's no noise, where you can concentrate, because this area might be a little new to you. It's not difficult, it's very simple. There are plenty of A-grade answers. But if you are concentrating, it will be very, very easy. All right. Okay. So shall we get started? So please type if the line breaks off or the connection is weak or whatever it is. Okay. So I hope all of you are doing well. I think by now I've got over 100 task 3A and task 3B. So well done. Well done. Of course, my worry is there are now 600 students who are doing in your batch. So this batch is a very special batch, okay? The highest number of students we've had so far is 592 students. So right now, when I speak, we have about 605 students in your batch, 605 students. But sadly, we have about 3 WhatsApp groups. Sadly, some of them don't join, but that's okay. They will watch the video later. But it's imperative that you follow instructions. This time's assignment is very simple. Probably from next session, there's a high propensity that will move into an online exam. So we might as well pass this time. And all these questions this time have been repeated in the past. So we will help you. But I want you to do your homework on a weekly basis and email it to me. Please follow the rules. Right now, I have asked you to do some homework for the audit. Complete all those tools. In addition, after today's class, you have to finish task 3 and send it to me in a PDF. So any difficulty, any problems you may have, you can always WhatsApp me and I'll be happy to help. Right? So let's get started with today's session. I think I shared the slides with you. So I will, if there is a breakdown in signals, I will put my video off. So Gihan is raising a question. Can you please touch a bit on 3A, 3C? 3C, we are going to do 3C today. 3A is the company background. That's very straightforward. I think if you watch last week's video, if you watched last week's video, 3A, I have shown you some samples. Every A grade answer, task 3A is the same. It's a company background, one page, right? No rocket science on that. So you can watch the video. 3B is a very simple question. You're really lucky. 3B is on strategic options. So if you look at any of the A grade answers, and if you read 2A in any of the A grade answers, it should do with strategic options. It should do with strategic options. So I've given you outline what to write. If you are new, I would advise you, you can't watch from the beginning because it might take a long time. Watch from the last 4 videos. Last 4 videos, maybe 9 hours. Last 4 videos. 9, maximum 10 hours. Watch the last 4 videos. That's actually when we started. That's actually when we started the case study, right? So watch the last 4 videos, and then you can start your strategic audit for task 1 and task 2, which is on Nintendo. And task 3, just open task 3, read the guidelines. Task 3A is very simple, right? It's about the company that you have chosen. So that is very simple. That is secondary data, basically, right? That is secondary data. There's no thinking behind that. I don't know why the examiner is giving you 5 marks for it. I was the examiner, I would have given it, right? Because that's in vain, right? There's no knowledge tested there. Then 3B, strategic options. Please watch the video. Today we are going to look at 3C. So on 3B, you were required to select 2 strategic options. So maybe, shall we do this? Can you please type? And I want the others to also see this. Can you please type the 2 strategic options you have chosen, but type it at once? Can you please type it so that we will see what options everyone is using? And if something does not sound like a strategic option, I will tell you. Can you please type what are the two strategic options? So Mihi uses alliances, product development, good. Product development, acquisition, CRM, product development, market development, only one deep. You have to type both. Differentiation, strategic alliance, market penetration, strategic partnerships, good. Market development and joint ventures, good. Acquisition and product development, good. So all these are correct answers. Market development and related diversification, good. Product development and differentiation, strategic alliance and product development, good. Product development and joint ventures. So you see, any approach is fine. Sangeet is using only one. You have to use 2. Market penetration, joint ventures, market development, right. Anishka, Rumi, 2 strategic options. 2 strategic options. Nadison, Ansoff's matrix is not a strategic option. Ansoff's matrix is a theory. And Ansoff's matrix has 4 strategic options. So you have to tell me what are the 2 you are selecting. What are the 2? Product development, Sandoshi, is only 1. 2 strategic options. 2 strategic options. So follow the rules very carefully. Please concentrate. 2 strategic options. Cost leadership and acquisition, good. Chanda, product development, only 1. Market penetration, strategic alliance, good. But now, one of the principles that you need to understand, guys, go and watch the theory on this. There are some strategic options that are a little risky than others. Risk profile is higher than others. So you have to make sure you understand that. We did that when we looked at theory. Example, diversification is 16 times more risky than market penetration. Then you also need to understand, can you invest? If you are saying, let's go and have acquisition, you need the capital and the funding power, right, to go for acquisition. I mean, you have to justify. So think within the context of your company, whilst all these are good options, maybe I'll ask you to change the options. Innovation is not a strategic, product development is a strategic option, Rajendra. So I need two strategic options. So it's wrong. You still have not given me two strategic options, right? Romy again, NPD, only one you are giving. Two strategic options. Please follow rules. Please follow rules. Can you see what others are doing? Please follow the rules. Building a corporate image, Satitra, is not a strategic option. I have not given that as a strategic option. That is not that's not in your syllabus. So you have to be theoretically strong. You have to watch the videos. I have given what the strategic options are. That means you have missed the plot. Satitra, you need to look at it. Product development, okay. Building corporate image is not a strategic option. It's not a strategic option, right? Product development is always, can be product modification, can be completely new game. So product development has three sub strategies. Someone by the name of Thali or whoever. Product development has three sub strategies. So it can be modification of existing product, right? Coming up with new size variations, right? Or quality variations, or game changing new products. So I think my comments are very clear. Smart students will understand what I'm saying when I say it the first time. Others who have missed classes, missed theory, you might have questions. Please ask me, but you need to learn fast now because we don't have time to cover theory in detail. You have to watch the videos. They are all there for you to watch. So a good practice is, I have a student of mine here from the UAE. He tells me every day he has to drive about 1 hour, and he every day puts the video on the car, and 1 hour going in the morning, 1 hour coming in the night, listens to one lecture each a day. So something like that, you have to just listen to it, right? Maybe if you can watch it, it's fantastic. So you have to do that now. Everything is available. You have to find the time, right? Okay. So shall we, so Vispini, you asking me a question in private. Maybe you can WhatsApp it to me, and so that we don't take time for today's lecture. Right. So shall we quickly start? Now this area can be a little technical, so please kindly pay attention. So today we are going to look at, actually funding options is 3C. Sorry, I made a mistake there. Funding options is 3C, right? 3C, not 3B, right? Right. So let me correct that. Now the good thing about this is, guys, this question has come about. This identical question came 2 sessions ago in the Toyota case study. Right? So here's the Toyota case study. Toyota Holdings, right? We had 43 A grades for Toyota. All the A grades on the portal. Have a look at it. So actually, task 2A was 3 strategic marketing options, 25 marks. This time you have 2 strategic options, 15 marks, 750 words. So that is this time 3B for you. So if you're struggling with this, go and look at many Toyota A grade answers. Benchmark them, don't copy them. Benchmark them, don't copy them. So this is done. This is done before. Now we also have 3B, critically evaluate the range of sustainable funding sources and financial approaches available to Toyota for implementing strategic marketing options outlined in 2A. So funding sources, remember I did a class, my last class with you. if you go back 5 videos, can you make a note? Please make a note. Can you go back 5 videos without today's video? Can you, after class today, can you download it or keep a bookmark and watch that video on funding options? I think we spent about 2.5 hours discussing funding options, debt and equity. So can you please make a note? Can you please make a note to watch that video if you missed it? Please watch that video because that is this question today in 3C. So 3C has again 15 marks, right? For your chosen organization. This was for Toyota, the case study. So you have a lot of A grade answers. Now, remember very carefully, this question here has been repeated before. Here's the question. Critically evaluate the range of, sorry, so this won't be for Nintendo. I made a small mistake there as well. Let's take that out. This won't be for Nintendo, right? Critically evaluate the range of sustainable funding sources and financial approaches. So this is actually the knowledge that the examiner wants to see in your answer. Funding sources and financial approaches. So what are funding sources? There are 3 types of funding sources. We will go into that today. We covered this. Retained earnings. Funding sources means what? Capital. Now you have come up with 2 strategic options. You are saying that will give you the best amount of growth and profitability. You're also showing in a line graph, bar chart, the growth and profitability. We discussed that last week. But now you need to fund those strategic options. You need to fund those strategic options. Now, when you are talking about strategic options in 3B, there can be 2 types of ideas. One is short-term ideas, short-term strategies, can be also long-term strategies. In between, you can have medium-term strategic options also. So if you talk more of market penetration, it's more short-term. If you talk about joint ventures, acquisitions, it's more long-term strategy, right? Maybe medium-term can be product development, market development, right? So now these short, medium, and long-term strategic options must be supported by funding options also that match short, medium, and long-term, right? So you have 3 types of funding sources or funding options. One is called retained earnings. We will define that and I'll go through that again. Other is called debt. Debt means you borrow. Debt is you borrow. Debt means you borrow. So if you borrow, obviously you have to go to a bank or you have to, there are other ways like leasing, factoring, so on and so forth, right? Same, but you have to borrow. Loans also, there are so many types, mortgage loans, unsecured loans, and so on and so forth. So we will go into that. Then equity. Now, some of you get confused with equity. Basically, equity means shares. Just remember that, shares. You have to give shareholding. Equity means shareholding, right? Just understand it in a very simple way. So those who are familiar with all this, bear with me, because I have to, there are a lot of marketers who are not familiar with this. So I have to start from the basics and explain things, right? So when you say equity, you give shares, you give ownership of some kind, but there are some shares where you can consider ownership, and some shares that you don't consider ownership, you just trade it, right? You just trade it, buy and sell it. So I'm not going to complicate it with jargon. But just remember, equity means shares, ownership. So you can fund your strategic options with retained earnings, debt, or equity. Retained earnings, debt, or equity. Then financial approaches, we covered some of them in my last class. When I say last class before the case study came out. So what are the financial approaches? We looked at NPV, IRR. Don't worry, okay? These are very simple. If you watch the video, you'll understand this. We understood financial approaches, right? We understood a theory called CAPM, right? We understood a theory called optimum capital structure. Sorry. We understood a theory called optimum capital structure. Let me go back. We understood a theory called optimum capital structure, right? Optimum capital structure. We did what we call working capital cycle. Ratios, we looked at some ratios. But you don't need all these knowledge in a very big way. Remember, you don't have a lot of word count. You have only 750 words, which means you will need to keep half of your word count here and half of your word count here. What does that mean? That means, 750 words, right? So if you leave the introduction and conclusion out, maybe 300 words each you can write. So that's very little. That's very little. So please be mindful. You can't write a lot. So although I'm talking about all these options, don't try and make it a very big story, because you have to write only 300 words, can be one page or even less than that, right? Even less than that. So I will show you some A-grade answers. So you don't need to panic. I am going to help you. Some of you, when you see numbers, you are always scared, right? So don't worry about it. So let's go through. Let's today try and structure the answer and go through these types. And if you have any questions, we can answer them. So I have given you, I'm saying when you start, okay, you can write the question on top: critically evaluate the range of sustainable funding sources and financial approaches for XYZ organization for implementing strategic marketing options outlined in task 3B, right? Now, as an introduction, I am proposing 3 bullet points, but please don't write all 3 bullet points. I am stressing this over and over again, because some of your introductions are 500 words. You won't pass. You won't pass. Then some of you say, so, but you have put to write about all this in the introduction. No, that's not what I'm asking you to do. I'm saying pick and choose from these ideas and maybe write 30, 40 words maximum for the introduction. Don't write more than that. So it needs to be a very small sentence, small paragraph, if you like, where you start the question, introduce the question before you go to the body of the answer. Now there you can talk about how your chosen organization should convert each strategic marketing option into identifiable projects with budgets assigned. Remember, in task 2, you are looking at strategic marketing options. So you'll convert them into a set of projects, timelines, accountabilities. Now don't go and convert it into, and show here are the timelines. You don't have word count for that. But you're here telling the examiner, it is important before you start funding, convert your strategic options into identifiable projects, budgets, timescales, accountabilities. We need to do that. Now don't cut and paste what I've written here. It will be plagiarized. Write it in your words, change the words, all that. And undertake we need to do a detailed investment appraisal for each project using investment appraisal techniques such as NPV, discounted cash flow, and IRR. Now, there are some A-grade answers who have done calculations on NPV, discounted cash flow, and internal rate of return. Not for Toyota. But if you read Walmart, if you read the Walmart A grade and get carried away, then there was a very important question on investment appraisal techniques. Then you need to talk about all this. So you don't need to show calculations on net present value, discounted cash flow, and internal rate of return. You don't need to show that. But showing the examiner that you have a knowledge of these by saying it is important that you do these calculations for this company to evaluate an investment appraisal. I think that's a good start. So that's one way to start, right? I'm giving you 3 options. Another good way to start is for you to say the first priority to fund your strategic options is with retained earnings. Retained earnings, that is your profits that the business has generated. You use them to fund your strategic options. But if you say you will use retained earnings 100% to fund your strategic options, then you can't answer task 3C. You can't answer task 3C. So you have to say we have to borrow somewhat, and we have to also look at equity options. Borrowing also, you can't borrow like whatever you want, you can't borrow. No, people are not willing to lend to you because there are caps. Banks say up to only this percentage we will, if you have borrowed in the past, we can't borrow beyond that. So usually they call it the debt service ratio. They call it the debt service ratio. So if you are above the debt service ratio, that means you've already taken a lot of loans, then you can't take more. No one will lend to you. No one will lend to you, right? Then you need to either go into retained earnings, but if you don't have that much of retained earnings, you have to go into equity options. So my advice to you is, now your job here is to demonstrate to the examiner knowledge. That's your objective. So talk about all 3. First, start by talking about retained earnings, right? First, start about talking about retained earnings. Then you start talking about debt options. So maybe 1 or 2 debt options. Then you can talk about maybe 1 or 2 equity options as well. So now some of you might ask me, Lewie, how many funding options must be used? Most A-grade answers have used 3 to 5. So there are examiner has given marks for 3 funding options, 4 funding options, 5 funding options. Up to you how much you want to write. Because you don't have word count, you have to explain what you have, right? What you have chosen as well. Is that clear? Is that clear? Right. So yes. So I can see some questions coming in. So we will take the questions towards the end, right? So now the first thing that you need to do is, so shall we read the second point? First priority is fund the strategic options with retained earnings. If this is not sufficient, the company would need to fund them with debt or equity funding options, right? Then you can discuss also the importance of selecting NPV positive projects. NPV positive projects. We discussed this when we did the last chapter, right? How you select NPV positive projects. If it's NPV negative, no point doing it. It's going to be a drain and you're going to run at a loss, right? So in the body of the answer, you have to explain almost all these areas. Now your challenge here is going to be word count. Your challenge here is going to be word count, right? So a critical evaluation of the sustainable funding sources. I'm suggesting you use these 2 headings in red, but you don't need to copy it. Please change it. Please change it. So critical evaluation of the sustainable funding sources, where you talk about the advantages and disadvantages of the proposed funding options, right? For each of the chosen strategic option and outline it. Task 3B, right? So you can't just make it, here are the advantages, here are the bullets. You can't do that. You have to apply it to the organization. So let's look at A grades. You have to apply the advantages and disadvantages to the organization. Okay, let's look at some of the A grades. It's very simple. It's extremely simple. explain that short-term strategies require short-term funding options and long-term strategies would require long-term funding options. So then what are the short-term strategies and long-term strategies? I'm going to show you a bit of a grid. Okay. Then you have debt capital, which includes bank loans, can be secured loans, unsecured loans, can be overdrafts, corporate bonds, debentures, commercial papers, and factoring, right? So these are all options available. Uh, in terms of debt, right? Now, don't get scared about some of these names like debentures and bonds and all that. If you want to just use bank loans, use bank loans. If you want to use overdrafts, so use overdrafts. If you're not comfortable talking about commercial papers, factoring, debentures, bonds, you don't have to. Like I said, start always with retained earnings. So you can say the total investment for all our projects is this. 20% of that will fund it through retained earnings. Then you have to decide, are we going for debt or are we going for equity? Right? Remember this very carefully. Can you take it down? Can you please take it down? Debt is always cheaper than equity. Debt is always cheaper than equity. Best option is to go with retained earnings, but you don't have retained earnings because you have given your shareholders their returns, right? So you then need to go into debt. So debt is always cheaper than equity. Remember that very carefully. That's one advantage of debt options. But debt is something that you have limitations. Sometimes you need a security. You need to keep something, maybe a premises, maybe your machinery, right? You need to sometimes keep some other asset. And the bank should be willing to take that as a lien and pay you give you the loan, right? So it must be a good asset. Usually if you have property, they're all considered good assets, right? So if you are not comfortable with debentures, bonds, and commercial papers and factoring, stay with, right, bank loans and overdrafts. Overdrafts means ODs. So banks would have to approve ODs for you. But this ODs and all comes at a very high interest rate. So you can Google some of the advantages and disadvantages of overdrafts. I have also given you some. Bank loans is very straightforward. What are the advantages? What are the disadvantages? Sometimes if you're a large company, people will not want a security. They will give you the loan. Depends on the size. And you want 100 million for 3 months. Company like MAS, banks will close their eyes and give 100 million, right? Not 100 million, will give you more. You want 1 billion, we'll give you more, because they know that those are established companies. So sometimes you might not ask for big security. But if a mid-sized company, small company goes, you will ask for security. You'll ask for security and mortgage it, right? You'll have to mortgage it, or you'll have to go into leasing or factoring, right? So let's look at these options. So today's class, don't try to understand everything at once, just understand the essence of it. So maybe you need to do some research after that, read up further. But don't forget, you don't need hardcore knowledge on all these areas for you to write the answer. But I can't do that. I have to give you a comprehensive answer. Please understand that. I have to give you all the options available and maybe try and explain all these areas as well. So, but if some of you find it difficult in some areas, don't worry. You stay into the areas that you're comfortable with, right? Again, 3 to 5 options. So 3 options also enough. So even if it's retained earnings, bank loans, and you go into equity, right? You go into equity, maybe you go into IPO, or venture capitalist, right? And you give them either ordinary shares or preferential shares. I'll come into that. It's very simple. Don't worry. It's very simple, right? So I told you equity means shares. equity shares, right? So shall we now start? Okay, before we start, second part of the question for maybe 300 words, financial evaluation, you have to talk about cost of capital, which means your debt to equity ratio. We did that in the class, in our final class. I will take you through today as well. Then CAPM model, weighted average cost of capital, optimum capital structure, right? Then I want you to try and draw a few diagrams here. I'll show you some A grade answers. Okay. There are plenty of A grade answers. You don't need to panic. I'll show you a little bit of workings, a little bit of formula that you plug in some numbers there. Very simple calculations, right? Division, addition, right? Simple things, percentages, very simple thing. So you just need to apply the formula, nothing else. Please understand, no rocket science. This is just plug the numbers. I will be checking everything. Don't worry. Okay. Then apply numbers, use some examples. You can get an A. And if you score good marks here, examiner will have a lot of respect for you, because not too many score marks here. Not too many score marks here. So if you score good marks here, examiner will have a lot of respect, right? So all the other questions, examiner will see if you're done an okay job. Maybe you'll end up getting an A, because these tough areas where most marketers may get wrong sometimes, you are getting a good score, right? Okay, now I'm going to go into a conclusion very quickly. So XYZ company should consider other factors such as the timing, investment timing, right? You have to be very careful. Sometimes if you go and invest something and then go into a large lockdown, then your business closes, then you are paying interest, right? So the timing is very important. Then you have to look at the seasonal aspects for the timing. Sometimes, that's why Apple launches their phones in September, mid-September, because they know by the time they distribute it, it will be October, November, and then the season comes. Everyone gives gifts for Christmas, holidays, and New Year. So their sales go through the roof. Sales go through the roof. So timing is very important, right? Environmental volatility. You'll have to look at, especially if you're getting loans, the duration, we call them tenors, right? The majority of your loans. Are you getting long-term 10-year loans? Are you issuing 5-year bonds? So you need to understand the tenors. You need to understand how, because that also means they're long-term commitments. That also means they're long-term commitments. So if your cash flow is good, you can pay some of your loans fast. And if you're paying your loans fast, the person, you can negotiate the interest rate. You can negotiate the interest rate and get a bigger loan from a bank, right? Then lending restrictions are there. Sometimes you might be leveraged, you might be stretched already. You would have got so many loans already. So lending restrictions might be there. Maybe your asset that you want to mortgage, maybe there's some problems. So then you can't, right? There's a restriction. Gearing ratio, how leveraged you are, right? Your gearing ratio, your geared levels, right? In terms of, can you meet all your liabilities with your assets you have? And you can there look at some ratios. You can look at liquidity ratios, short-term, long-term liquidity ratios. There are a few numbers that you can apply, but don't worry about this, right? Because you don't need to show a lot of numbers. The idea is what you need. The idea is what you need. And then a basic application, because 750 words, you can't do a lot. Please understand that, right? Please understand that. Now you need to be careful here. You need to be careful here when you're reading A grade answers. Check how much word count, because sometimes A grade answers might be 1250 words and you'll write maybe 1200, but for 500 marks, 500 words, you are overboard, which means you won't get marks. So the challenge in CIM is putting your thoughts across in the rules that are specified by the examiner, right? So you can talk about the risk involved in each of these options, equity, debt, all involve an element of risk. Cost of the source, I told you debt is always cheaper than equity. Debt is always cheaper than equity. Then the long-term impact to service the debt that needs to be looked at. Your collateral, which means the security that you need to keep, right, to borrow, especially debt. Contingency plans, what if you can't repay your loans? What are you going to do? Are you going to declare bankruptcy? If so, there's going to be a huge problem, right? Reputation issue. So what are the contingency plans? What are the contingency plans? Impact on shareholder value for embarking on the proposed funding option. So you can have a small concluding paragraph. Maybe you don't have a wherewithal to use numbers here, but write it in your own words saying, these are some things that you need to consider before us moving forward with debt and equity options, right? All right. So I think I'd like you to use some of these words. Now you can't write definitions, right? And the question is not on the first four. Please remember that. The first four areas are not questioned. Payback period is not questioned. Net present value is not questioned. Discounted cash flow is not questioned. IRR is not questioned. But you can somewhere mention it to the examiner to show I have knowledge. I have knowledge because they are in the syllabus. But don't please go to town with it because it is not questioned. The question is on the last part, cost of capital. Question is on that. Cost of capital, that's half of the question, first part. Right? Second part is the financial approaches, right? So shall we look at, so I think we looked at what NPV means. So you will focus on NPV positive projects. NPV positive projects. We discussed this. I'm just going through, we discussed this, okay? I'm just going through the slides very fast because we discussed this. We discussed this. If there is a new slide that we have not discussed, I told you the fifth class from today, which was the last class before the case study came out, it was funding options. Please watch that video because I can't repeat that again here, but I want to remind you, if you followed that, I want to remind you what we did then. I want to remind you what you did then, because we are now looking at the question, right? So it might be helpful if you can watch that video pretty fast, then the theory will be very strong and it will resonate when you're writing the answer. So funding sources, there are three approaches, right? First of all, there's a cost to capital. Hello, there's a cost to capital. If you want capital, right? If someone is starting a business and says, why don't you, can you give me so much of capital? I'll give you so much of shares. So now, if I have that capital in a bank somewhere, I have to liquidate that fixed deposit and give that person and invest. So then if I'm getting 10% on my fixed deposit, if I'm investing in a business and if that person is giving me 9%, what's the point? What's the point? I'd rather keep it in the bank, safe. So if I'm investing in business, I need to get 30-40% returns, at least. Maybe after we break even, after about 1.5 to 2 years, depends on the payback period of the project. I need to get 30-40% minimum. Otherwise, there's no point taking risk in business. Isn't that right? Okay. So there is a cost of capital. There's a cost to capital. Remember that. So this capital can be funded in three ways. One is retained earnings. That's what you see here. So retained earnings means, what is retained earnings? I have given a definition. Retained profits, right? Usually the lowest cost in terms of funding because you have it within the business, the profits we have made already. You don't pay your shareholders that. You don't pay your shareholders that. You tell your shareholders at the annual general meeting, we have a few NPV positive projects. We have a few NPV positive strategies. We are going to keep the profits and reinvest it in that. So sometimes shareholders might be happy. Some shareholders will not be happy. Hello, are you with me? So usually who makes that decision? Usually the board of directors will make that decision. Heavily influenced by the majority shareholders. Heavily influenced by the majority shareholders. So minority shareholders sometimes will not have voting rights. They will not have a say. They will not have a say. They won't even have a board seat. They won't even have a board seat. Right? So if you don't have a board seat, then if the majority of the shareholders say John Keels will retain its profits in 2021 and not pay dividends, not pay dividends. We won't pay dividends in 2021. Sorry, shareholders. Annual general meeting, chairman will say, sorry, this year we are not paying dividends. This year we can't pay dividends. Why? Because we have few projects coming up. Adani project is there, the terminal project, we just signed it. Then we are short of funding on the John Keel's property, big property project, right? So we need retained earnings. We can't go and ask, we have profits, we will use that because that's cheaper for low cost funds. So then some shareholders, small shareholders, which have no say, okay, right. But that's also okay because they are investing it in the NPV positive projects. Hello? They are investing it in the NPV positive projects, which means sometimes with that investment, your share price might appreciate. So they will gain. Shareholder will gain. Shareholder will gain. But there are some small shareholders, they always ask for dividends every year, right? So you reinvest it back into the business. Utilization of retained profits may result in an opportunity cost, right? An opportunity cost of payment of dividends. So that's something that the board of directors need to carefully manage. So always, guys, I'd like all of you to start by talking about retained earnings. Talk about retained earnings. At least try and fund 10% or 5% of your strategic options through retained earnings. And don't forget, please use some numbers there. In task 1 and in task 3B, when you're talking about strategic options, growth and profitability, you're showing sales growth and profitability. Then strategic option investment, show the investment also. Can you please make a note there? Show the growth and profitability of revenue and profits, but show the investment also year on year. So you can show 3 lines: growth in revenue, growth in profits, growth in the investment over 5-year period for whatever strategic option. Now, if you show that in one bar chart, examiner will say, oh my God, the student is thinking strategically. Then when you go to part 3C, it's very clear then what is the ROI or the ROE, right? The return on equity or the return on investment is very clear, very clear. Year on year, it is there. Year on year, it is there, right? So shall we now look at types of funding? Shall we look at types of funding, right? We'll look at types of funding. So you have bank loans, which can be personal loans. If it's a very small company, you can fund it. But big companies can't take personal loans. You have to take bank business loans. So when you're taking business loans, there can be clean loans. Clean means no collateral. That's what it means. It's a clean loan, right? Or it can be an overdraft, right? It can be an overdraft. It can be a mortgage. It can be a mortgage. Usually, you have to mortgage if you're taking a big amount. Okay. Then you have corporate bonds and debentures. So another form of debt financing is bond issuance. Companies can issue bonds, right? A traditional bond certificate includes a principal value, a term by which repayment must be completed. So you have to pay bond buyers back, right? So you will pay them interest and you will pay the capital investment also, right? Individual or entities that purchase a bond then become creditors by lending money to the business. So bonds are available and Debentures also there. I'll show you the difference between bonds and debentures in the subsequent slides, right? So if some of these things are complicated, you have to only talk about the advantages and disadvantages of this, okay? And then give a value saying, right, we are going to fund 5 billion from a debenture, 3 billion from a bond, and we are going to have a bank mortgage loan for 1 billion, 1 billion, right? So think sometimes not in millions, think in billions, depends on the company you selected, okay? So if you select a large company, if you say we are earning 10 million and all that, I will laugh at you, Simon. I know when I say laugh at you, Simon, not in a very rude way, but what I'm trying to tell you is you have to think strategically. You have to think strategically because 10 million and all you can't fund, right? Right. Even Cambridge College, I told you, we are looking at going to Australia. That project is costing about 100 million. 100 million. Okay. So, a small company like us going to a new market, if it's costing 100 million, imagine a big company. So, you have to think in billions because when you convert billions into pounds, examiners familiar with pounds, it's not a big investment. And if it's a 5-year investment, I mean, you can then look at a billion and then you amortize it for each year, right? You break it up into each year, right? Okay, so credit cards are available, but only can be used for very small operations. You can't use it for very big businesses. So I don't recommend you use credit cards. Factoring, invoice discounting, we will look at that. And commercial papers. And commercial papers, we will look at these definitions. I'm going to explain it in detail. So there are equity financing options. We went through this. Angel investors, venture capitals, crowdfunding, corporate investors, initial public offering. So you have to give your shares and they invest. They will invest, right? So equity financing, try and use one at minimum and maybe 2 or 3 maximum. Don't use more than that, right? I will show you. So I explained this to you before in our last class. I'm not going to explain it again, but if anyone needs an explanation after you watching the video, please contact me. I'll be happy to help, right? But initial public offering is usually if you're going to list your company for the first time, that's just called initial public offering, IPO. You are going public. Now, Cambridge College is not a public quoted company. Public means what? You're listing yourself in the stock market, where people can buy share, big people can buy and trade, right? Sell your share. So if you now usually it's also called another word we use is a floating. You float, right? It's called a floating. You float, right? That means you give some shares of the company to be traded. Obviously, not controlling shares. Don't give controlling shares at once, but you give a small amount of shares. That also you have a choice. You can give existing shares or it can be a new share issue, right? So don't worry about those technical things. We don't have all that in our syllabus, but I'm just explaining some of you for you to understand. Might be easier. So sometimes if now Cambridge College has 100,000 shares, I can create another 50,000 new shares, speaking to my company secretary, and those new shares I can give, right? 10% or 20% of my company, I can float it using IPO and it will trade in the market. It will trade in the market. So IPOs, you would have seen in the newspaper, some companies, right, are saying sold out in the first day, right? So there's some marketing story also there. When you say your stock has, sometimes they go and buy themselves. When you say themselves, they have buyers. They use other buyers. If by 4 o'clock in the evening it's not sold, or 3 o'clock in the evening before the market closed, they will use other companies, right, and say buy, buy, buy. Because it's a nice thing when you say we are oversubscribed. It's a good thing for the brand. Wow, what surprise! My God, oversubscribed this. So then it's nice for the share. It's nice for the company. You build the equity. You build a lot of reputation for the organization, right? So that's a good way. If you're not listed, don't feel shy to go into IPO. Now, if you go into IPO, you need to discuss, am I going to give ordinary shares or preferential shares? So I will come into that. I will come into that. Of course, there also you have so many types of preferential shares. So you don't need to get so granular. You don't need to get so granular. If you want some reading material later to read further of what are the types of preferential shares and then what are the advantages and disadvantages of each, I'll send you some reading material. But all that is not in your syllabus. All that is not in your syllabus. Okay. You certainly don't have word count to write all that. You don't have word count to write all that. So let's say if you select three, put things in perspective. If you select three funding options, you have only 100 words each. 100 words each for each funding option. That's it. So you can't write a lot, right? You can't write a lot. Just the essence is what the examiner requires. All right. So we went through this debt financing, advantages, equity finance. What are the advantages? We went through this. I'm not going to go through this again because I want to cover some new areas today. So please watch the video. Debt, what are the advantages? Equity, what are the advantages? Debt, what are the disadvantages? Equity, what are the disadvantages? I told you one of the biggest advantages of debt is much more cheaper than equity finance. Debt is much more cheaper than equity finance, right? Now let's come into this one. So I will take some questions in the end. If you do have any questions, just hold on to them. Just remember the slide number and hold on to them because I want to cover a restrictive area today. I want to cover some areas today. So please don't type your questions also. Just keep your questions and let's look at it in the end. You can unmute and ask. You can unmute and ask. All right. So shall we now watch a small video and come back into this? Take a small 1 minute breather and come back into this. Shall we do that? Okay. So let me play a small video and come back. So I hope I can play this. Let's hope, because if it's not loading, then we will stop it. Okay. I hope I can play.
Such heights we reach together. Stepping in time, tread our own path, we won't fall Futures now.
All right, let's start. Let's start. So I want to now talk about the rest of the slides. I want to talk about the rest of the slides. And I look forward to some questions from you at the end, any clarification, but don't complicate it. Simplify, right? So now I spoke to you before and I told you there are some strategic options which require short-term funding. So example, if you are proposing market penetration, you need short-term finance, market development, product development. Now slowly you're getting into medium term. Medium term means can be 3-year loans, 5-year loans, 5-year bonds, and so on and so forth, right? Hybrid strategy, strategic alliances. Strategic alliances onwards, it becomes long term. So maybe 7 years, maybe 10 years, or maybe 15 years, right? Joint ventures, right? Mergers, related diversification, acquisitions, all these become so. Market penetration require more working capital funding because it's to do with more promotions, it's to do with advertising campaigns, and so on and so forth. That's market penetration. So my advice to you is try and challenge yourself here. Select some strategic options that require some serious investment. Then you have a lot to talk about when it comes to funding options. So I mean 10 million, 20 million are very, very small investments. You have to talk about big investments. So the examiner will applaud you, will reward you with good marks. So challenge yourself to think about bigger, riskier, but depends on the organization. Now, one thing the examiner will look at here is, are you contradicting the information you're saying in 3A? Because in 3A, the last bullet talks about the company background, talks about constraints, limiting factors. So if you, for example, say that we have been running for a loss for a very long time, owing to COVID, our business is seriously impacted. And if you go and recommend, let's go and buy a company. And let's go into debt options and equity options, long-term loans. How can you do all that? You're probably heavily geared right at the moment. So you have to be very practical. You have to be very practical. So company selection, strategic option selection will all fall in line with your funding options. Right? So if it's not practical, I will tell you, Uda, I don't think what you're saying is practical. Right? So it's up to you then to change it or not to change it. I won't force you. Right? So methods of short-term finance, debt and equity options are both available here. So immediate financing, usually you can negotiate credit from suppliers. You can negotiate credit from further credit. So if they're giving 30 days credit to you, can you go for 90 days or 60 days or 45 days? That's another way to improve your working capital cycle. Improve your working capital cycle, right? Then you can collect from receivables early. That's another way. So you can extend your suppliers, your creditors that you need to pay further. You can improve your cash flow then. Another way to, for short-term finance, so whatever you have to collect from your debtors, collect it fast. Usually you give 90 days, but can you collect it in 60 days or 30 days? Then your working capital improves. Then you can get temporary ODs, overdrafts from banks. But banks today don't give overdrafts, big value overdrafts. I mean, certainly 100 billion, 100 million, 1 billion, they don't give. They will give it to Dialog, they will give it to MAS, they'll give it to Nestle, big companies only. But otherwise, you will maximum get like a OD 5 million, 10 million OD. You won't get very big ODs, depends on the size of your organization. Mid-sized company might get 5 million, 10 million. That also you can't go to every bank in town and ask them because there is a crib. You can, when you put your company on the crib, it will tell you what are your other obligations you're borrowing. So you can't just go to, we have 26 banks, let me go to all 26 banks and get 10 million each, then I am 10 million into 26. It doesn't work like that, right? So there is a limit of debt that you can go up to. Other banks will see your exposure, right? So that there is a limitation. Up to a certain point you can borrow. After that you can't. Then negotiated financing, you go into short-term loans. Maybe you will mortgage, maybe you won't, depends on the company. ODs, overdrafts. Overdrafts is like a revolving loan. The difference between a term loan and an OD is, OD, let's say when you get some checks, you can deposit it, it refreshes. Again, you issue some checks, it goes negative. So again, you collect some checks, then you deposit it, it becomes. So OD is a permanent credit line and it's a revolving loan, right? But most of other loans that banks give you are fixed term loans, right? So I don't want to get into the terminology of banking with you and confuse you, but it's called an EMI loan, where, right, you use equated monthly installments. So don't complicate it. Equated monthly installments, that's a term loan, right? Where there is a fixed component and a tenor, which is a period that you pay, right? Just like a personal loan that we borrow. You understand, when we go and borrow a personal loan from a bank, it's an amount that we can pay from our salary for the period. But if you get a overdraft, it will be 1 million overdraft. Most businesses have it. And then checks come in, go out, that overdraft will get serviced or not serviced. If it's minus, then you get interest charged. If it's plus, you get a small, maybe very small interest paid, right? Business loans don't get a lot of interest. So factoring is another option available. I'll explain that, and commercial papers. Now let's go into the definitions. So short-term loans are, I think, straightforward. Credit lines based on the bank's assessment of the credit worthiness. Is a loan facility generally offered for a specific tenor, reviewed prior to renewal. Conditions are there, right? Unlike a long-term loan, there is usually no periodic repayment. And the company is liable to pay interest based on outstanding facility, right? So that is a short-term loan. OD, I explained to you, is a flexible arrangement, is a revolving loan. Overdraft is used for short-term financing. You are liable to pay interest based on the overdraft facility. Granted usually against a security asset, right? So sometimes if you want a large OD, you need to securitize it with an asset. If you can't service it, then the bank will go into what they call a parate execution. They'll have to file in the court of law saying that we have to recover this money. So we have to sell the asset, and they can sell the asset and the bank can fund their loan. Okay. It happens quite a bit. A lot of people default, and then you have to give your house or your car or your hotel business, you have to give, can't help. Machinery, you have to give the bank. Okay, it happens quite a bit. Now, what is factoring? Now, you can select factoring based on the organization. So what it means is, in factoring, before I go into this, let me explain it to you. Now, let's say you are selling some goods. Let's say you're selling some goods and then your buyer will ask for let's say Cambridge College will do a training program, large scale training program for MA staff. How many staff? 60,000 staff. We do a large scale training program, but MAS has told us they are going to pay us only in 90 days, 3 months. Now, Lewie Diasz can't wait for 3 months. So Lewie Diasz will go to a factoring company, maybe Sampath Factoring, Nations Factoring. Most banks have factoring facilities. So I'll go to a factoring company and I'll tell them, Sampath Bank Factoring Department, my client owes me for a training that I'm going to do for him, and he's going to pay me in 3 months. MAS, reputed company. He's going to pay me 100 million in 3 months. I'm providing the service today. He's going to pay me. He wants credit. But since MAS is a good company, 100 million is the value. Can you pay me now? I need money. Can you pay me today? But I don't need 100 million. Obviously, they can't pay 100 million to me. So Sampath will come and tell me, okay, 90 million we will pay you today to your account. 90 million will pay you today. 10 million is our fee. 10 million is our fee. We will keep a small fee and we will collect it after 30 days from MAS. We will collect it after 30 days from MAS. So who benefits? Everyone benefits. MAS benefits, Sampath Factoring Company benefits. Me, I also benefit. Of course, there is a lesser amount I get, but I get cash fast. Got it. So they will usually charge 5%, 10%, 15%, depends on the value, because they have to collect it. Now, if MAS does not pay after 90 days for whatever reason, if they don't pay, then I'm not liable. I've got my money. I don't need to give it back to the factoring company. So they take a big risk. The factoring company takes a big risk. That's why it says, I want 10%. I will collect from MAS. Of course, I have to sign a tripartite agreement, factoring agreement, but I will collect from your client who's a reputed client in 3 months. But if they default, they will be at a loss of 100 million, Sampath Bank. So, but I benefit because my client is very good and I get the money upfront. So the selling of receivables to a financial institution, the factor maintains a credit department and performs credit checks on accounts, allows firm to eliminate the credit department and the associated costs. Saving on expenses is in maintaining credit department. Transfer titles, so a little bit of technical stuff, with or without recourse to bad debt. Commission depends on the size of individual accounts, volume of what is collected, and the quality. So if it's MAS, it's okay. But if I go and tell them some small place in Peta owes me 100 million, can you factor this? They won't factor it. They won't. Maybe they'll ask 50% because there's a high risk. Maybe they'll ask 50% high risk commission, right? So they'll price the risk. Cash paid on due date of receivables unless advance paid for which interest is charged. So you can negotiate all, when the price will be paid. Sometimes it will be paid immediately. Sometimes it will be a month later. Sometimes it will pay staggered payments as well. So now invoices, all those things you will share and you will come into a joint agreement, right? And there are many factoring companies today. It happens even at a small scale, because margins are very high. So there is some propensity for default. Defaulting is there, but the upside of the factoring company for collection, because their margins are very high. Margins are very high. So it's a very good business. But you have to carefully select your clients. You have to carefully select your clients because there are two other parties involved, right? So that is factoring, and there are advantages and disadvantages. Commercial papers. A commercial paper is a form of unsecured short-term debt commonly used by companies to finance their payrolls, payables, inventory, and other short-term liabilities. It usually lasts for a few days or weeks or a month, right? So a commercial paper is again not secured. It's a short-term debt commonly issued, right? Uh, of course, once someone accepts the commercial paper, right? It is generally used by large corporations. So what it means is now, let's say MAS, big company, right? Big company. All of a sudden, they have got some large orders and they have to order some stocks. So their working capital is impacted. Now, if they go, now they have already used all their overdrafts. They've already maxed all their overdrafts. Uh, Loans also, they have got quite a bit. But loans, sometimes if you go to get loans, uh, a loan approval takes time. But commercial papers can be done really fast. Depends on the credibility of the organization. So the organization will say, do it on a commercial paper. Loans, I don't have time to give security and all the loan documentation, fill it, and for you to wait till you. So commercial papers are fairly fast. It's a short-term unsecured promissory note. So it's like a promise. So you have to be really good creditworthy. You'll be creditworthy. Generally issued by large corporations, underwritten by a bank or a dealer. So a lender has to be there. Cheaper and faster than a short-term business loan. So it's cheaper also. Cheaper and very fast. So you can turn around a commercial paper in 1 or 2 days, right? And it's cheaper as well than a fully fledged loan, right? You because you are going to settle it very fast, because you have to pay salaries at the month end. You are really stuck. You have to order your raw materials, but then in another week's time we'll have the cash. In another week's time we'll have the cash. So then going and getting a loan and mortgaging and filling all, and then closing the loan, all that becomes a headache. All that becomes a headache. So then a commercial paper, if your credit worthiness is good, they will quickly lend to you, right? From a commercial bank. Generally issued by creditworthy, high rated companies. So SME kind of things usually can't get commercial papers approved, but big companies, banks go behind them and say, look, don't bother filling forms and loans and all that. We will serve you commercial paper, 2 days approval, funds in your account. Let's do it. Here's the rate, lower rate, right? So you take that risk. The bank takes the risk, but you have to pick your clients, carefully. Okay. So there are advantages and disadvantages. Now let's go into long-term funding options. Long-term funding options. So again, there are debt options, equity options for long-term funding. So debt options, you have bonds, bank loans, bonds that can be issued by the company, and bank loans that can be obtained by the company. Equity, you have ordinary shares. You can issue shares, maybe through an IPO or any other party who's willing to buy. Preferential shares are available. Retained profits are also equity that you reinvest. Okay. So equity, there are advantages and disadvantages. I'm not going to go into this. This was discussed in our last class. Equity, there are advantages and disadvantages, right? Every option, every funding option, there are advantages and disadvantages. Okay. It's like you picking a boyfriend. It's like you picking a boyfriend. Every boyfriend has an advantage and disadvantage. No, same with girlfriends also. Okay. I didn't say girlfriends first, then you might think I'm a sexist. Okay, but same. Uh, every option has advantages and disadvantages and associated risk involved, associated risk. So you have to weigh the pros and cons and jump into it. Okay, right. So debt options, advantages of debt, disadvantages of debt, we have done that, but I'm giving you some additional notes, right? Corporate bonds and debentures. Shall we spend some time here? So a bond is a security issued by a company as a means of borrowing from the public. Now, you can't be a very small company or mid-sized company and issue bonds. There will be a fairly large company. It represents a promise to pay bondholders a fixed sum of money called the bond principal. So people can go and subscribe to bonds, and then you will get your principal back, the investment amount, at a future maturity date, along with periodic payments of interest called coupons. Okay, so the word terminology is interest that you get, right? It's called coupons, right? So don't get carried away with the terminology, but it's very simple. The interest are called coupons. The principal amount, right, is the bond value. Now, this bond issuance, usually you might get a bank involved. Okay, usually you have to get a dealer involved or a bank involved. You can't yourself go and issue bonds because bonds are traded in the share market. Bonds are traded. You can buy and sell company bonds in the share market. So therefore, if you are issuing bonds, you sometimes need to be rated. You know what I mean by rating? You have Fitch, you have, this AAA, B plus, even like our country, we have a rating, no? Financial rating. Companies also have ratings, especially if you are a public quoted company, you need to have a rating. If you are a public quoted company, you need to have a rating. Uh, and there are some companies that are quoted that don't have ratings, but if you're a large scale company, investor confidence will be built if you have a rating. Then people know when they buy, they know what is your risk of your business. So if you go into banks, large banks are like AAA banks. Then you get B plus banks, B plus banks, B minus banks. So C banks. So you can see even banks move up slowly. Sometimes during bad periods, they get downgraded, right? So you have to look at the rating. Usually before, if you have a fixed deposit, before you go and put the deposit in the bank, you just check the rating of the bank. What is the financial rating, Fitch or whatever it is, right? So offers high risk and higher yields compared to government bonds. Now I can go and buy a government bond. Government also issues bonds saying they'll pay back coupons and principal value. But Sri Lankan government bonds little risky at this point of time. You know the Greece government bonds, no? Greece also people went and bought. We in Sri Lanka also we went and bought Greece government bonds and they defaulted, right? They defaulted. So you have to be careful when you're buying bonds from countries. Good rated countries is okay, but countries that have difficulty, right now there are a lot of countries issuing bonds. You have to be careful. You have to be careful. You lose your principal and you lose your interest also, right? So companies can issue bonds, needs to be rated. Uh, Otherwise, people won't subscribe. So offers higher yields than government bonds. Government bonds are usually considered to be much better than company bonds as a safe for investment. But right now, I don't know. Most governments are struggling. Companies are looking better. Okay. Can be traded prior to maturity like shares. You can trade it in the stock market. Can be traded in the stock market or a counter between broker bank acting for the clients. So there are securitized bonds, secured bonds, and unsecured bonds. So the company pledges specific collateral such as property, equipment, and other assets that the company owns as a security for the bond. Okay. So if you provide a security, bonds are essentially loans that are secured by a physical asset. If you are doing an unsecured bond, that is not called an unsecured bond, that is called a debenture. That is called a debenture, right? It takes fairly high risk, but return is also better. So you have seen this, no, in the newspapers, debenture issue of this company. So it's a good thing, but you have to think about the company. What is their rating? What is their business? How well are they doing at the moment? What are they issuing the debenture for? What is the project that they want to fund? So you need to do a little bit of due diligence. And then, of course, you can buy the debenture, but no security. No security. On the other hand, are unsecured debt instruments that are not backed by any collateral. So, but your interest is higher than a secured bond that you get, right? So now the terminology is very clear: bonds and debentures, right? Coupons, principal values. Bank loans, fixed loans, variable loans, floating loans, stepped up loans. So many types of options are available in terms of interest rate, right? I think that's very straightforward. Now, there are three fundamental types of issuing equity or shares. Okay, one is a IPO. We spoke of that, of flotation. Then there's something called private placements, and there's something called rights issues. So I'd like you to touch on these. I'd like you to touch on this. Right. So shall we go into this? Shall we go into this? What do you mean by IPO? I spoke to you about it. Right? Yeah, okay, with time. No? What do you mean by IPO? Initial public offering or flotation. Offered at a fixed price or tendered, can offer new shares to existing shares. I told you, you go public for the first time. That's called IPO, initial public offering. You get listed for the first time in the stock market, IPO or flotation. So usually you'll have a merchant bank that is an issuing house, and they acquire the shares and they become the intermediary to offer it to the public. You have to watch out for what we call stagging, or people buying and selling quickly. That's a bad thing, because otherwise on the day that you go public, oversubscribe, next week your share becomes a terrible share. That's a very bad thing for your reputation, company's reputation, right? But it happens to a lot of companies. There's something called IPO lockup period, which is a restriction preventing from staff, because usually sometimes when you have IPO, you offer your staff the first preference to buy shares before you go public. It's a nice gesture where you offer your staff saying, here's the price. Sometimes it's slightly lower priced than the market price, lower priced than the market price. So there might be senior management, some directors, they'll all buy shares. But the IPO lockup period ensures on the day you go on the IPO, you can't go and quickly sell those shares at a higher price and make money. Right? So there is a lockup period for about 180 days. So try and use these thoughts, right? Try and use these thoughts. You can see them also in A-grade answers. Private placements are a little different, right? So private placements means, now IPO, when you look at IPO, you go to the market, you don't know who's going to buy your share. Sometimes your competitors will also buy your share. And there will be a lot of useless shareholders. Sometimes at these AGMs, you get these people who have 10 shares, 20 shares, who come and, waste your time. I mean, Must to be done. Shareholder can come for the AGM, but we'll ask hundreds of questions. Why did you go and invest here? Why did you go and do that? So it's a damn nuisance when you go public. Sometimes people who buy 10 shares, 100 shares, also shareholders. But at the same time, uh, they're not the best people who should buy your share. Serious investors should buy your share. Serious investors. So you therefore can go into private placement. So what do you mean by private placement? Shares are placed directly with certain investors privately on a pre-arranged basis. On a pre-arranged basis. So I won't, if Cambridge College is listed, if we are a listed company already in the market, and if I want to raise money using a private placement equity, maybe I want a big company to buy 10% of Cambridge College. So if I go public and offer that 10% of new shares in the market, I will have so many people who will buy it. I don't want them as shareholders. So I can speak to maybe some very, very senior business people in this country, right? Maybe dialogue owners, or maybe, I don't know. I'm just giving you examples. Some companies that have good credibility that I like to work with. And I can go and have a meeting with them, private meeting with them, and say, hey, I'm offering new shares, right? This is the price, the number of shares. Are you interested? It'll be about 10%. Are you interested? So pre-arranged basis. So that's called a private placement, or short form placement. Then the third option is called a rights issue. So the rights issue are new shares offered to existing shareholders. New shares offered to existing shareholders, usually in proportion to the size of their shareholding. Now again, before you go to the market, right? Let's say I have new shares that I want to sell. I can do a private placement. I can do a private placement, but still I have no takers. Still I have only sold half. I have another half of shares to sell. Before I go and offer it in the market and I let everyone, unknown people also buy my share, I will do a rights issue. Rights issue means I have to go to my existing shareholders and tell them, hey, are you interested to buy? Are you interested to buy? Right? So new shares offered to existing shareholders, usually in proportion to their size of shareholding. The right to buy new shares ahead of outside investors is known as preemption rights of shareholders. It's easier to organize than public issues, right? It's very easy to organize private placement and rights issues. Issues price slightly lower than the market price. So that is the disadvantage. Market means there'll be a vast majority of people who buy. And you can see our stock market, no, every day we are breaking records, right? So there are different kinds of buyers in the market. But private placement and rights issue, you go to known devils, right? You don't go into unknown territory. Okay. So now I hope you have got this terminology clear. If you are looking at equity options, talk about IPOs, or if you are not a listed company, then you can raise money through initial public offering. If you're already a listed company, you are going to private placements or rights issues, or you can go into new share issue in the market, But then first look at private placements and rights issues before you go to the market. Now, there are many types of shares, but broadly two types, ordinary shares and preferential shares. Preferential shares go into many types, but you don't need that knowledge. You don't need to get that granular, right? You don't need to get that granular, but understand the broad two types of shares. It's very simple, okay? Don't complicate it. I know some of you are finding it difficult, but don't worry. Let it sink into you. It's very simple. Watch this video a few times. If you have any questions, I'd like to meet you. We'll have a chat, coffee, and I will explain. But you have to buy me coffee, okay? Right. So ordinary shares. So ordinary shares and preferential shares. Now, remember, if you're buying shares, let's say one day you want to trade in shares, one of the best questions you need to ask is, or first questions you ask is, are they issuing ordinary shares or preferential shares? Because there's difference. There's a difference, right? So ordinary shares, they are known as equity shares. Why? Because ordinary shareholders have a voting right. Voting right. Preferential shareholders do not have voting rights. So they can't influence the companies in a very big way. Therefore, ordinary shares are considered real shareholders. Preference shareholders are considered people who will buy. They don't have any equity. I mean, they have shares, but they can't influence the company anyway. You understand? They can't influence the company. That's the first point. They are not owners of the company. They are not considered owners of the company. You're just a shareholder. You're not an owner of the company. But if you have ordinary shares, you are an owner of the company, even if you have one share, because you have voting rights. Shareholders of these shares are the owners of the company. Shareholders have got voting rights. One share, one vote usually. These shares have greater risk. Owners of these shares receive dividends after preference dividends has been paid. So first you have to give preferential shares dividends, then only ordinary shareholders get paid, right? Because they are owners of the company. Okay. Ordinary dividend is not fixed. It varies with the availability of profit, i.e. more profits, more dividend, no profits, no dividend. Okay. Now, preferential shareholders, they are not the owners of the company, but they're shareholders. So preferential shareholders have no voting rights, no voting rights. The shareholders receive a fixed rate of dividend. So again, there are different types of preferential shares. There are different types of preferential shares. So I'm not going to go into that. Maybe I can send you a note on that. It's very straightforward. But and I don't want to confuse some of you, because in 300 words, you don't need to go into all this. But if any of you are interested to read and to maybe use that knowledge, I'll send you. There are 4 or 5 types of preferential shares. But if you talk about ordinary of preference and advantages, disadvantages, that's more than enough. You don't need to get extremely granular. You don't have the word count. Okay. So preferential shareholders have no voting rights. The shareholders receive a fixed rate of dividend. The rate of dividend is given before the word before ordinary shares. Therefore, it's called preferential shares, right? In the event of liquidation of the company, if you're winding up operations, they need to be paid before the ordinary shareholders. Then preferential shareholders need to be paid before the real owners of the company. They are usually of a lesser risk. Okay. So these are the 2 different types of shares. So now I want to go into A-grade answers. Shall we look at A-grade answers? Look at how simple this is. This is one of Toyota's answers. Critical evaluation of sustainable funding sources. This student has recommended debt, capital, bank loans. Can you see the pros and cons? This is the answer. This is the answer, right? Can you see the pros and cons, which means the critical evaluation? In terms of debt capital, Toyota is able to opt for bank loans to finance their strategic options. The funding source that Toyota is able to easily obtain due to brand strength. But there are pros and cons of debt. So can you see, this is a great answer. But so it concludes by saying this funding source can be used for all 3 strategic options, right? Long-term loans will be given whilst for market penetration, right? Differentiation, short-term loans will be given. So I spoke to you about that. You have to show the examiner that you have to match your borrowing, whether it's short, medium, or long-term, with the strategic option, short, medium, or long-term. Okay. Now, equity capital, what is equity? Shares. Second option, this student is saying, okay, we will issue ordinary shares. So now you know that what is ordinary share, right? Equity capital, on the other hand, is of a low risk to Toyota, as ordinary share will be chosen as the funding source, which is basically owning the company's, right, shares. There are pros and cons. There are pros and cons. And then retain profits. Retain profits. Now, you can look at many A grade answers. Don't only look at this. Here's another one. Can you see? The student has gone into a rating and a ranking. Advantages and this student is using debt, loans, and overdrafts. Advantages and disadvantages. Preferential shares. You go into, this student has gone into not ordinary shares, preferential shares. Then gone into advantages and disadvantages. Then corporate bonds and retained earnings. Retained earnings. So can you see, this is the first part of the answer. First part of the answer. It's very simple. Don't complicate it. Right? Then you go into the second part of the answer, which is the financing approaches. Financing approaches. Now here I went through these theories with you. I'll very quickly go through them, but if you want a detailed discussion, you have to watch the video 4 sessions ago or 5 sessions ago. You have to watch that video, the last class on what we did on this area for 2.5 hours. So weighted average cost of capital is a theory that you need to use, like with a small example like this. Use a small example. Don't copy the same diagram. Don't copy the same diagram. Remember, I showed you a Walmart A grade answer, 86 marks of Akib. I think I sent that student stuff to you, right? In that, that student has explained a simple calculation of weighted average cost of capital. I'll show you that. I have a screenshot of that. So what do you mean by weighted average cost of capital? What do you mean by weighted average cost of capital? You will use both debt and equity. Debt will have separate loan rates. Equity will have separate cost of funds, right? So you will take what is the cost of debt, what is the cost of equity, and then you'll understand the weighted average and the weighted average cost of capital, the weighted average cost of capital. So I did this in a very detailed sense. So watch that video, because I don't have time to do the whole thing again. But weighted average cost of capital is the average cost between debt capital and equity capital. The average cost between debt capital and equity capital. Can you see here? Cost of debt is much lower than cost of equity. So when you're using the example, use it accordingly, right? Cost of equity is higher than cost of debt. So there is a formula available. This formula that has been used here, right? The formula that has been used here for weighted average cost of capital looks a little complicated, but try and look, is simple. Can you see multiplication, division? Nothing big, okay? No sine, cos, tan, beta, nothing, okay? Only multiplication, division, minus, right, plus, and you arrive at what the weighted average cost of capital is. So now this example here I took you through is for the same numbers that are used here. Is for the same numbers. Can you see here? 12.3 weighted average cost of capital. And you can see if you use the formula, 12.3. So try and dissect this, watch the video. Maybe you can use a diagram and show the examiner. Maybe some students have not used diagrams. They use the formula and show. It's up to you. Some students have used both. You have used the diagram, you use the formula, There's no hard and fast rule. Word count is a decision that you need to take. It's a very serious decision. So A grade answers are available for students who only use the formula without the diagram. A grade answers are available for students who only use the diagram without the formula. But explain. And both also have been used as examiners given A grade. So you have to prioritize based on the word count what you want to do. So this is actually the formula and then applied in that example, right? So I spoke about then the next concept, which is the expected return. Expected return should always be higher. Expected return should always be higher than the cost of capital. Already, capital cost is there. Return must always be higher. Now, to understand the expected return, we use a method called CAPM. CAPM calculates the expected return of a security, which must be always higher than the weighted average cost of capital. Okay. So I explained this formula. What is the expected return? Is a function of your risk-free rate plus beta into market risk premium. So please watch the video. We did CAPM. You can use this simple formula, plug in some numbers. Don't worry, examiners. I mean, these are not real numbers. Just use some fictitious numbers. Just give an example. Plug in the numbers and come up with, right? Come up with what is your CAPM formula. What is your CAPM formula? So you can give these values. I'm not going to explain all these. I explain beta, I explain market risk premium and risk-free rate. They're very simple things, right? Risk-free rate was, for example, the treasury bill rate. Okay, the treasury bill rate is usually considered the risk-free rate. So go through this, use a simple equation like this and explain what is your expected return using this. All right. So watch that video. If you find it difficult, let me know. I'm willing to help you. Let me know. I'm willing to help you. Right. So optimum capital structure is the third theory that you need to use. Now, many students, actually some students have used this diagram itself. So what is the optimum level of capital between debt and equity that a business can use? So if you look at this example, again, it's very simple. Some companies can use 50% debt, 50% equity, like you see here, right? Some companies can use 60-40, 40-60, 65-35, or any other percentage. That will depend on the business risk and financial risk. Now, optimum capital structure is something I took you through for you to understand the debt to equity ratio, right? You have your total assets and then you have your debt to equity, right? Again, you can see what is a lower leverage if your debt is low, but your equity is high. But if your debt is high and your equity is low, then you're highly geared or highly leveraged. You're highly leveraged, right? Other way, you're lower leveraged, right? So debt to equity ratio is a ratio that you can also use and give some simple examples, percentages, absolute values. Again, plenty of A grade answers have used debt to equity ratio, right? So the optimum capital structure, this diagram, I hope you can remember this. I explained it. You have your debt in green color, right? You have your equity, the cost side on the equity. And then you have the average line. You have the average line, right? Weighted average cost of capital, right? Weighted average cost of capital is in blue. Cost of debt is in green. Cost of equity, I told you, cost of equity is always higher than cost of debt. Now, what do you mean by the optimum capital structure? I explain this. Let me do it again. It is the lowest average cost of capital. Can you see here? If you add these two up and divide it by 2, that's the average. No? So the average here is going down, going down, going down, going down like this. At some point, it starts to increase because these two are increasing. So it has to increase at some point. So average goes down, 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 weighted average cost of capital. But this is the point where it starts to increase. That is the optimum capital structure. So optimum capital structure is, you can see here, debt 70%, equity, debt you will use 30%, equity you will use 70%. That is the optimum capital structure. That will tell you what ratio of debt to equity you should use. What ratio of debt to equity you should use. Right? Now, no major calculations are required, but conceptually you need to explain it. So can you see, this is the 86 mark student. Can you see, this student has said, I am going to have an investment of 185 million. Equity funding is 60%, debt funding is 40%. Then financed by debt 40%. So you can see cost of debt is there. Debt is tax deductible. So you can, after tax, there is a rate. I have given this example. After tax, this is the rate. Equity is not tax deductible. Debt is tax deductible. Then you have your weighted average cost of capital. 40% of 4.2 is 1.68. Can you see cost of equity is always higher than cost of debt? Right? So you have equity side financing 60%, 111 million, right? And then cost of equity is 12%. So use some assumptions. Use some assumptions. And then when you look at 60% of 12% cost, you can see the weighted average cost. So when you take the weighted average of these two, when you take the average of those two, the weighted average cost of capital is calculated. The weighted average cost. So can you see 1.68, 7.2. So you can use the same formula. This is the weighted average cost of capital. So the weighted average cost for the proposed innovation project is 8.8% after the combination of both tax deducted debt and equity. Wow. Very simple. Very simple. 86 marks. That's it. One diagram. One diagram. That's it. Right? Very clear. Very clearly laid out. This is from 86 mark student, 22-year-old. He has just followed the rules, what I've given him. Nothing fancy. Just follow the rules. So you can see some others. Again, this student, this is a grade student as well, who has drawn this optimum capital structure model. Again, use the weighted average cost of capital equation, calculated cost of equity and cost of debt. And then the student has gone into the CAPM model. CAPM model, right? As you can see here, again, use the formula I have given the student, right? Use the formula. Then use the formula, arrived at the beta market risk premium. I have given all this, right? And the risk-free rate. And then return is higher than, the return is higher than the CAPM, which means that the stock price is too low and should rise. So you can give a small explanation like that. Hence, CAPM security return has to be higher than the cost of capital. I have explained that, right? So if you want to illustrate it graphically, you can do it. Otherwise, you don't have to. Otherwise, you don't have to. Remember, whilst I have taught you all these things, you don't have word count right about everything. Please remember that. Please remember that. So we have 5 minutes more. This is another student's work. Actually, this first part is one student's work. Can you see? Second part is another student's work. Second part is another student's. That's it. Okay. That's it. The student has said it's good, neutral, weak. So find a nice way to present it. You're very lucky. You have many A grade answers and students who have done this before. So you can benchmark, but not copy. Okay. All right. So that's about it. Any questions? I have 5 minutes for questions. Please unmute and ask. Please unmute and ask. Not very clear. Please unmute and ask. Please unmute and ask if you have any questions. Does anyone have any questions?
Yes, cost of equity, how do you arrive at 12%? Cost of equity, the earlier slide.
This one? Oh, so that's an assumption. Okay, that's an assumption.
Oh, that's an
assumption. Because you know equity also there can be so many equity types too.
Yeah.
You have
so cost of debt is the interest. No, cost of debt 6% is interest.
No, not only interest. It's a cost of debt. It can be interest. It can be so many other forms also, right? So don't go into
other forms. It'll be when you're borrowing money, it'll be mainly interest.
No, I mean you might have mainly interest, but you might have other forms of upfront fees and so many types of fees. No, depends on the type of borrowing you go into. Depends on the type of borrowing you go into.
So but cost of equity is purely assumption.
Yeah, I mean both of these are assumptions. Those are just you plug in the numbers to show what your weighted average cost of capital is. But this is not a real. You're not really doing a funding option. You're just showing the examiner. I know what the formula is and what the how to use it. So, but real numbers you don't need. So don't go and ask the company. Just plug in the numbers like this. Okay. So don't use the same numbers also. It is a big problem, right? Try and change it a little bit. But it's very simple. It's not very difficult.
Now the financing, you give it in euros or in US dollars. Okay.
That doesn't matter. That is immaterial as long as you state it is fine. So it can be INR, it can be rupees, it can be pounds, it can be US. It doesn't matter. Again, it's positive marking. It's knowledge. Examiner will see whether your argument is okay. Knowledge is there. These other things you don't need to worry too much. Good. Any other questions?
So small one, like in funding options, funding sources, the part 1, that do we need to use the numbers or figures?
Funding options, not really, unless you want to here and there show what is the NPV positive project, what was the IRR. I mean, it's not really required. As you can see, no student has used. Right, some students have used, some students haven't. You see, this is a critical evaluation, so you can here you can talk about the rates. You can, if you want to, how many shares you are going to issue, right? You can talk about all that also, and what is the price, target price per share. Are you corporate bonds? What is the value, and then what is the coupon rates, and you can give some examples. Not a problem, but as you can see, that is not really. You're not doing this is not a course where examiner. This is not CIMA. This is not a CFA. So please understand, this is not chartered accountancy. That's a separate profession. As long as you critically evaluate the advantages and disadvantages, that's the question. So, but now if you really want to use an example here and use it, it's fine. It's fine. You want to put your gearing ratios, couple of other working capital ratios, solvency ratio. If you want to show off to the examiner a little bit more, it's up to you. It's up to you, but not required. This is a great answer. This is a great answer. Critical evaluation.
So then next one is like IPO for non-listed companies, right?
IPO is an initial public offering, correct? Yes.
Yeah, for non-listed companies, right?
No, you can most often you might need to be listed to go public. You might need to be listed to go public.
Then for rights,
Rights issue also. So for rights issue, so if you have a listing, it's always better because then they can, the people who either private placements or if you go into a rights issue, you can command a higher price based on your rating. Based on it, but private placements are possible without also ratings. Without also ratings. Rights issue also possible without ratings.
thank you, sir.
Sir, even though new product development is a short-term investment, is it okay if we go with bank loans?
I mean, it's okay. Don't examine it. I told you it's positive marking, right? So don't, I mean, as long as you've done a decent job talking about the advantages and disadvantages of bank loans, it's fine. It's fine.
Thank you.
Any other questions, guys? Any other questions? I think there are some questions typed, so I'm not going to look at it, but could you please unmute and ask, please? Kindly unmute and ask if you have any questions. Is this difficult? I'm asking a question. Is it a little challenging? It's okay. Is it a little challenging? Yes.
Sir.
Huh?
Hello, sir.
Yes. Yes. Please speak louder.
Shafiq here.
Yes.
Are you able to hear me?
Yes.
Okay. Actually, I think it's referring to the question because some marketing students may find it difficult because we don't have the financial background. So I think getting really to know these concepts and applying them could be a little bit challenging for us, right? Because we are not working in the accounting field or we have not got the experience.
So what is your question?
So my question is, if we take numbers, specific numbers as an assumption based on the trends, market trends and the company situation, would it be fine? Do we need to really work out real numbers into equations?
Real numbers are not required. Can you mute your mic? There's a bit of disturbance. So to answer your question, real numbers are not required. All these are assumptions. Real numbers are not required. Don't use real numbers. But now this is theory that I did. Like I said, I have done this class. So you need to watch that video. If you need, after watching the video also, if you have any questions, you have to get in touch with me privately. Don't generalize. Usually I don't generalize. Say now, you might have a difficulty doesn't generally mean that everyone has a difficulty. So if you have a difficulty, let me know and I'll help you. But something about these things with all these models, I need to tell you, most of them are available on the internet, and there are plenty of videos. If you want really detailed understanding of CAPM, whatever it is, you can watch a couple of those videos. But I'll be happy to help you as your tutor if you really want to understand. But I have done a video already on debt equity, types of debt, types of equity and all that. So this is level 7 qualification. So you are required to conceptually know now bank loan advantages and disadvantages. That's not difficult. That's not difficult. Equity shares. What are the advantages and disadvantages? Are you using ordinary shares or preferential shares? Nothing number based. There's no numbers here. Retained profits. How much of retained profits are you going to reinvest in the business for NPV positive projects? So there's absolutely no numbers here. The number part actually come in the second one. The number parts, you can give a simple example like this. Again, this is a student's work. So try and plug in the numbers into some formulas like this. Don't worry, I'm here to help you. When you plug in, if you do it wrong, when I look at your work, I'll say, Puta, this part is wrong. Let's fix it. And I will help you. Okay. So
okay,
tomorrow you don't need to submit this. November, end of November, we have a lot of time. Don't worry. Don't worry. Okay. Don't go and my God, think this is so difficult and my God, what have I signed up for? It's actually very simple. A grade answers for the same question hundreds of A-grade answers are available for the same question. So you don't need to worry. Just look at the template, change the numbers a little bit and arrive at it, but don't copy it word to word, right? But if you're taking a equation, for instance, then that's okay. That's why you have 20% plagiarism. Examiner won't penalize you for taking the formula. Formula is one, but they change the numbers. Now this is looking at 185 million. You put 250 million. It's fine. Then this is looking at debt is 40% and equity 60%. You change it to 50 and 50. Finished. Right? And then arrive at these numbers. And if you're struggling with it, I'll help you. Don't worry.
And this is for clarification only. If it is for a non-listed company, you can't go for debt and equity. Am I right? Debt and something else for funding.
No, debt. Go for equity also because IPO is available. No, IPO is available. You can go. You can have an IPO. Of course, you can go for equity. Go for equity because you know why? Yeah. Why I'm saying that? Because you have to show the average cost of debt and equity. Yeah. In the next one. So if you don't go for that, then you can't score marks there.
But suppose if it is a multinational company where we are not a listed company, then how would it go?
Even multinational company has issues. They have new share issues, rights issues, private placements. Even multinationals. Multinationals, of course, they are traded. No, their stock is traded in the market.
As of now, in the local market, no. But can I suggest it as an option?
That is your company. No, don't get carried away with what realities. The examiner is not really interested in your company. Is it the real? Are they listed? Not listed? Is you also in AAA? They have not got a rating. Examiner has better work to do. Examiner only let you think. Even if you say if it's actually not listed, but you say it's listed, is fine. It's allowed for you to do that. Examiner is saying adapt the company to suit and to score marks. You get what I'm trying to say? So examiner has better things to do than call and say, hey, is this company listed in the stock market? You know, that's not.
But I only think if at the time of the introduction, if you put it as a non-listed company, then you will get caught, no?
Yeah, you can't contradict yourself. That's very clear.
Got it. Thank you.
Okay. Any other questions, guys?
For a multinational company, as a Sri Lankan branch here, can you borrow it from the main parent company? Can we?
Can, but then there still goes into debt, no? Because sometimes parent might have different shareholders, country subsidiary might have different shareholders. So still debt, still you go into debt.
Okay, thank you.
Any other questions, guys? Yeah.
In critical evaluation part, should we pick the funding sources and few funding sources and apply to the relevant area?
Critical evaluation part, here is a critical evaluation, advantages and disadvantages, basically. Yes. So you have to see funding options and then talk about, given those strategic options, what are the advantages and disadvantages of each funding option?
I mean, are we allowed to select a few of funding options?
I told you, no? 3 minimum, 5 maximum.
Okay, sir. Thank you.
Okay.
In the graph that you have shown, 70-30, it's 70% is debt and 30% is equity, or the other way around?
It doesn't matter. Usually, it doesn't really matter. Right? As long as you give an example, so some of you might use the same. Don't get involved in the technicalities, right? So don't look at examiner is not really interested. Is this the, is this the correct interest rate? Is this the correct optimum capital structure? As long as you show it as the lowest and you put a formula there, that's what the examiner is, and you show 70-30. That's what the examiner is interested in. So it doesn't really
matter which is 70 and which is 30.
No, it matters. Now, obviously, debt is always higher than equity. So it depends on your formula that you have said here, right? Depends on what your formula that you have put here. And then also now to explain the optimum capital structure, you might need to explain it using an example like this. So then based on this, you will understand whether 70% is equity cost or debt cost. But in my example, I have just taken a screenshot. I have not taken the same example into that.
Okay, thank you. Yeah.
So based on your argument that you're building here, you'll take it there, and then obviously you'll say 30 is what, 70 is what. Okay, good. Any
Sir,
other questions? Yeah.
So small one, is there any way to download whole folder in Google Classroom?
Okay, that you might need to speak to Aisha or Jason. I'm not sure about that. I'm not sure
Okay,
about that.
okay, thank you, sir.
All right. Okay, thank you very much. Good night. So homework this week. Now, one more thing. I might have a session on Saturday morning on your appendices only, a short session. Go through your appendices. So please keep 10 o'clock Saturday morning free. I might have a small session to only discuss the appendices with you. Appendices for the Nintendo case study. But otherwise, we will have class next Wednesday. We are going to discuss 1A, task 1A. By next Wednesday, I need to see task 3 completed, email to me PDF. And then I need to see Nintendo homework for the strategic audit of what I've given you. All right, and then we will discuss task 1A next Wednesday. But Saturday, I might have a special session at 10 o'clock with you on the financials of the appendix. We will take a deep dive into that. All right. Okay. So thank you very much. Good night, guys.
Thank
Stay
you,
safe.
sir.
Thank you.
All
Good
right.
night.
Thank you.
Thank you very much.
Thank you, sir.
Thank you,
Bye-bye.
sir. Good night.
Good night.
Thank you, sir. Good night.
Thank you. Thank you. Good night.
Thank you, sir.
Good night, sir.
Thank you.
Thank you, sir.
Bye.
Thank you, sir.
Good night, sir.
Good night.
Hari-hari kau kadang dulu.